Dobrý den a celý rok, dámy a pánové, vám přeje partner Save & Capital, globální strateg Roman Chlupatý. Vítám vás u lednového vítězného portfolia. Jde o speciál, ve kterém vám nabídneme debatu s viceprezidentem a portfolio manažerem Franklin Equity Group Grantem Bowersem. Zaměříme se na americké akcie. Na úvod jsem se Granta zeptal na to, jak pravděpodobné podle něj je, že v dohledné době zažijeme nějaký výraznější propad.
Well, I think we have to look back over the last couple of years, right? We saw a very steep or deep correction in 2022 as the Fed was increasing interest rates. The market was selling off, and as we came into this year, 2023. It was, in many ways, the most predicted recession of all time. Everybody was saying the market is going to sell off. We're going to have a recession. The effect of the interest rate increases hasn't hit the economy. And what has happened? The market is up 15+%. It has rallied on sort of contrarian positive news from the U.S. consumer. It's rallied on strong corporate earnings. As well as an interesting tailwind that I don't think anybody saw a year ago, which was what's going on with generative AI and the secular tailwinds of technology and innovation. So if I had to make a prediction, I think we've seen the worst of the market sell-off last year, and the outlook as we look forward into the fourth quarter of 23 and 2024, we think is actually reasonably attractive. We think the setup is positive in many ways. That earnings will actually start to reaccelerate in 24, and that while a recession is still out there in the horizon, we think that any really economic downturn in the U.S. would be quite shallow and not really a deep, structural recession. It would be much more sort of a technical recession in the market, which is good for equities.
Brilliant. A couple of very interesting motives, themes. So let's deep dive, if you will. First of all, U.S. consumer. That was a big question mark. There were a lot of expert voices claiming in the second half of this year, meaning 23, we're going to see their reserves depleted. And that's when the problems will start. Yeah. Is it off the table, or is it still something that you follow, you essentially watch, because it can be the deal breaker, if you will, in this kind of a scenario you just outlined?
Absolutely. And the U.S. consumer and consumer spending accounts for about 60+% of U.S. GDP. So the consumer is infinitely important to the outlook for the U.S. economy. When we look at the data, we see a U.S. consumer that has very low sort of debt service levels, meaning they took advantage of low interest rates the last 5 years and refinanced their debt and paid down their debt. So their balance sheet is healthy. Employment remains very strong. So unemployment levels in the U.S. are in the mid 3%, which is very attractive. Job creation remains healthy. And also importantly is wages have been increasing. So we think that the U.S. consumer has been much stronger than people expected because they entered this sort of period healthier than in past periods. So our outlook for the consumer actually remains quite robust. And we think that consumer spending may see some, cracks around the edges at the low-end consumer. But as long as employment remains healthy in the U.S., we think that structurally the consumer will remain healthy as well.
Okay, let's focus on where the opportunities are then, since you're saying the robustness is quite strong or well, let's say, and there is something to work with. Where do you see opportunities at the moment on the American market when it comes to stocks, of course?
Yeah. So, when we look at the market, we focus on investing in businesses that we think are high quality, that have strong competitive positions, and businesses that we think can grow not just 1 quarter or 1 month, but that can actually grow over 2, 3, 5 years down the road. So the true sort of long-term winners is where we want to be focused. We're finding a lot of opportunities in the technology sector. We're finding a lot of opportunities in the healthcare sector. And then also in some of the areas around financials. Not necessarily the banking sector per se, but financial services broadly. So maybe if we just drill down a little deeper into that, I think it's what we're seeing take place in technology, not just from a digitization or a digital transformation of the broader economy, which is a huge multi-decade long tailwind, but now we've added in this sort of, I don't want to call it a surprise, driver, but it didn't exist. It wasn't on anybody's radar a year and a half ago. It was generative AI, and what that is bringing from a spending and an investment cycle, as well as from a potential driver of productivity, of cost savings, and really creating a really impressive sort of secular tailwind for growth for the technology sector broadly. So those are the areas where we've been focused, and we continue to find opportunities in this market. As we've seen in the U.S., a lot of the returns have been driven by the Magnificent Seven, and I think it's noting that the market is bigger than that and broader than that, and we're finding opportunities in a lot of different areas.
There has been a lot of speculation about the AI bubble. Some people were talking about the reminiscence of the dot-com bubble of the end of millennium.
Yeah.
Would you say that there is some truth into it, that some technological companies are overvalued simply because they follow the lead, if you will, of the Magnificent Seven, and some other companies that are probably deservedly on the valuations that are right now?
Yeah. So I mean, if we think about the generative AI and whether or not that's in a bubble, I think we are in the very earliest days of this shift and focus on generative AI as a technology sort of secular change. We are not seeing signs of a bubble in any of those areas, partly because it's so new. I think as we look out and think about how this will evolve, it's not unlike what we saw with the creation of the internet in the mid-90s, or the launch of the iPhone, which created a mobile ecosystem. The initial hype is very strong, but very focused on just a few companies. And then we enter into a period where people start trying to understand who are going to be the winners, who are going to be the losers, and you end up with a multi-year time period where the winners are essentially evolving and running their playbook and starting to adjust to this new paradigm. We think generative AI will be like that. That the initial hype is justified. This will be a very big market opportunity, but we're going to, in the next 6 or 12 months, start to say, well, who's winning? Who are the revenues? And we may not be seeing them immediately. It may take a couple years to play out. But we think behind the scenes, the investments that are being made by businesses are going to pay off handsomely and be very strong. So we continue to be positive. We don't see signs of a bubble. We think that the areas outside of the Magnificent Seven are very attractive in the technology space.
What does it mean in particular? Give me an example of one concrete firm that is not as visible as the Googles and Metas and others, but is at least as interesting as these big ones are.
Sure. So I would use Adobe software. And Adobe is a software platform for creative professionals. I think many people are familiar with the name. Even if they don't use it, they've heard of Adobe. Adobe is uniquely positioned to benefit from the ability to build AI-driven co-pilots or assistants into their software, which they will charge customers for. It will broaden the market because it will become much more user-friendly. So the creators and creative class of professionals should actually grow quite dramatically because of AI. And the ability to access those tools is what Adobe will present and provide. And so, there's a name that I think people have probably heard of. They don't necessarily think about them as an AI, winner, but ultimately they're very uniquely and very positively positioned to benefit from what this generative AI these tools bring about and the natural language models bring about.
One company I have to ask about, and that's Tesla. It is, and it is not a technological company. It's somewhere, the hybrid of tech and automotive.
Absolutely.
How do you read the late development?
Yeah, so we own Tesla in the portfolio. We continue to like Tesla. We believe that the EV sort of shift, that transition that we have seen already take place, will be a multi-decade long transition, and that ultimately, the world is moving towards EVs. Tesla is the low-cost leader. They're the market share leader, and historically have been actually the technology leader. So we think that they're in a really unique position to benefit from this shift. Recently, we've seen them cutting prices quite dramatically. to put pressure on the competitors. And what we believe is profitability for the competitors will struggle, but ultimately they will respond with better products at lower prices, and that'll be a positive for the whole industry in general. So we continue to like Tesla.
What do you think about Elon Musk? Because to some investors, to some experts, it's sort of a wild card, if you will, an unknown because of his mercurial behavior, and certain projects such as X are seen as controversial. Yeah. Is it something that one should actually factor in as well when deciding whether to invest and how much to invest into Tesla?
I think you should. I think it's a balance, right? You have his genius and the ability to create multi-billion-dollar businesses, Tesla, SpaceX, what they're doing with X, all his other companies, and then you balance that against his ability to focus, maybe not be distracted as a leader, as a CEO. As an investor in Tesla, I would love it if I had 100% of Elon Musk's time to focus. I think they have gone beyond the startup phase. It is a multi-billion mega cap company. They have a very deep leadership bench, and Elon is still there. So I think we're comfortable with his role, but yeah, you have to factor in his distractions into the broader investment sort of case. But right now, we think we're okay.
You've mentioned financials as another interesting sector. What are the titles or groupings, if you will, that you like, and which ones you wouldn't recommend to invest into right now, at least?
Yeah. So, the financial sector is going to be a big beneficiary of a lot of the digital change, the digitization of the financial industry. And think about it moving from that traditional retail banking world to more of a personalized, data-centric, mobile type of world. And the winners are going to be the payment companies. So we have a position in MasterCard, which is a large position for us, benefiting from this transition from cash to debit, credit payments. And that's global, right? It's happening worldwide. And we still have a long runway there. So we think that the payment companies are natural beneficiaries of financial change and evolution. One area we're not as positive on is really what I would say the traditional bank. There's a lot of interest rate risk. There's a lot of lending and consumer credit risks, as well as just the natural evolution of the financial system changing to these more data-centric, more personalized, more mobile type of environments.
When we look at the classical, let's say, division of small and mid-sized banks and big banks, there's a clear trend of monopolization, if you will, at least concentration.
Yeah,
that's
concentration.
That's better word, sorry, of power.
Yep.
Is it going to continue? And thusly, do you expect another round of problems of these small banks that actually pose, at least to some, certain systemic risk?
Yeah, so I think if you look in the U.S., as rates rose last year, we had a banking crisis, right? We had Silicon Valley Bank went out of business, First Republic went out of business. But amazingly, the economy was incredibly resilient. The industry was structurally sound, and the regulatory environment reacted. And so in the larger scheme of things, it was just a blip, and the economy continued to move forward. We viewed that as very positive and a great sign of sort of the strength of the U.S. economy. Are we going to see more banking crises? It's tough to predict. I think every financial institution, there was a bit of a warning shot, and everybody has now retrenched, assessed their risks, and mitigated them. especially, when we think about where our outlook on interest rates in the U.S., we believe that rates will remain higher for longer, but we think the Fed is probably at the end of their rate cycle and the end of their increases. And so directionally, banks can do, if rates are stable, that's okay. It's when they're moving up or down dramatically is when you start to see parts of the system crack.
Is crypto an interesting part of the future financial system? Are you active in that realm, if you will, or not?
Yeah, so we have no exposure to crypto. I think crypto and digital sort of tokens and digital currency is a really interesting phenomena, and I think there's going to be a lot of use applications for them. I think there's going to be a lot of use applications within blockchain and a lot of the sort of general ledger, digital ledger aspect of it. We don't have investments in pure crypto. We tend to be much more focused on public equities and listed equities rather than the crypto side.
One question that relates to this one, and that's the future of central banking. And now I'm talking in particular about the tokens that the central banks are already developing, or some, like the Chinese National Bank, are already testing. Is it going to somehow significantly change the sector as such? Commercial banking as well, among other things, because of course there's a certain reason behind the hypothesis that it will somehow systemically shift the way that things are being done, let's say.
Yeah, and I guess, it's a little bit out of my depth, but I think one way to think about it is, by nature, digital currencies are disconnected from the government-controlled financial sort of apparatus. And so if you have a government-sponsored digital currency, doesn't that sort of go against the whole premise
Oxymoron.
of why you would have a digital currency? So that alone probably precludes real widespread adoption because it isn't consistent with the sort of premise behind a lot of these, Bitcoin and what they bring to the table, which is a disconnected currency from, financial systems and government-controlled financial systems.
And you mentioned healthcare, so let's look at healthcare. It used to be not all about, but to a very large extent about COVID. What is the name of the game right now for you?
Yeah, so I think healthcare is a really unique sector that has a lot of big long-term secular drivers. And as growth investors, we want to identify industries where we see sort of tailwinds of growth. And we look at healthcare, we see an aging middle class around the globe. We have an aging population around the globe. We have a rising middle class, which structurally means more demand for healthcare. So to us, the opportunities in healthcare are really a sort of multi-decade long, which is higher utilization, higher demands, more people expecting healthcare to deliver results. We think that the pharmaceutical and the biotech industries are very well positioned. We think the tools and devices are going to be very well positioned, and that they're all really poised in a way to sort of deliver what we think is sort of what I would call stable, consistent growth, even in uncertain sort of economic environments. And those are the companies that ultimately perform very well and generate a lot of alpha for investors over a long period of time.
Give us an example of one of the titles you have in your portfolio, and why, again, what's the reasoning behind how you actually get to the point where you do the buy or you send the buy order?
So a great example of a company in the healthcare space that is bringing about a lot of innovation and a lot of change is called Intuitive Surgical. So Intuitive Surgical is essentially makes robotic assisted surgical devices and surgical machines, which allows doctors to perform very complex, precise surgeries with small incisions, less invasive, faster recovery time, better outcomes, faster healing for patients. And it actually is, if you think about it, it isn't robotic surgery, it's robotic assisted surgery. So you're giving doctors tools to do a better job and have better outcomes for their patients. And so Intuitive is a name we've owned in the portfolio for many years. What we see is they continue to add new procedures to their sort of platform, and there's greater adoption globally of the Intuitive Surgical sort of devices and machines. And so we think the long-term outlook is really bright, and that increasingly this is the way surgeries will be performed, which is more microsurgery rather than big sort of operating table-driven surgeries.
So these are, let's say, do's from your perspective. What are the don'ts at the moment? Are there any sectors that you wouldn't buy into simply because you perceive the risk as too high or the expected yield too low?
Well, I think maybe I'll take it even at a higher level. And you think about the U.S. equity market, and we have value, and we have growth, and secular growth, and cyclical sort of companies. I think an area you want to be cautious on is the more sort of cyclical aspects of the market, more value-oriented, slower growth companies with big legacy operations, lots of debt, stable profits, but not growing. If we think about our outlook for the U.S. economy, we think that GDP growth will moderate some in the next year, and that inflation will continue to improve, but rates will probably stay high. And in that backdrop, more cyclical companies that have high cost structures should be impacted disproportionately, meaning profit margins will constrict for them. And that's an area of the market I think you want to be cautious on. And so, we focus a lot on secular growth, whether it's healthcare innovation or digital technology or consumer. We think these are the places you want to be focused, and less on the more sort of big industrial, old line economy type companies that all did very well last year, right? And they all did it phenomenally last year in a high inflation, rising interest rate environment. I think future looks to lower inflation, lower growth, and probably still high interest rates, and that'll be a headwind for them.
How about defense? You're an ex-serviceman, ex-military, so it is quite close to you, this realm.
Yeah.
Is it interesting? And not only because of the wars that we're fighting now as Westerners.
Yeah. So I think, the defense sector is, in a weird way, a secular growth industry, right? We are, expending a lot of the tools and weapons that we've built up, but we're restocking and rebuilding. I think we're seeing an increase in spending from the NATO countries in Europe after years of underspending. And, geopolitical conflict is now, we have it in Eastern Europe, and we have it in the Middle East, and we may have some of it in the Asia-Pacific region. And ultimately what you're seeing is countries are increasing their budgets. And history tells us they don't increase their budgets for 1 year. They increase their budgets over a decade, because these are very long cycle type of investments.
Where in particular would you say is the value? Of course, cybersecurity is one that is being, for obvious reasons, discussed a lot.
Yep.
Something else that you perceive interesting?
I think cybersecurity is a really interesting area of the market. I think what's happening with a lot of the AI tools has only probably increased the cybersecurity risk. Other than that, it's really the big, when you think about like defense areas, it's really the big global defense companies who are the suppliers. I mean, that's an industry that has consolidated dramatically over the last 20, 30 years. And those big players will be the suppliers of choice. I think you'll also see some sort of geopolitical alliances. I mean, you saw in the US, they came to a very broad arrangement with Australia around nuclear submarines. Australia is buying those submarines from the U.S. companies, essentially. So in many ways, the U.S. ends up being a big beneficiary of a lot of this spending, as they have the biggest defense and industry companies out there.
That's one way how to perceive the geopolitical risks or unknowns.
Yep.
In more general terms, is it something that you pay more attention to lately? Because it seems like there is a sort of a return of geopolitics. It was never gone, but it was sort of at the background, right? Yeah. Now it seems that the fragmentation is picking up the pace, and that we're gonna be witnessing more and more conflicts, small, large.
Yeah. You know, I don't want to discount it, because it's definitely something we factor in to our models and our risk assessment. The U.S. is somewhat uniquely positioned, as we don't have the same levels of exposure of Europe or even China to these different end markets where you see a lot of stress. So, you know, the U.S. has, you know, energy independence, so we're not as dependent on rising natural gas or oil prices. We don't have the same deep trade relationships with some of these countries and regions. So the U.S. is uniquely positioned. While geopolitics are important, they don't actually impact the bottom line nearly as much as they do other areas. But it's something we're very much paying attention to and are very aware of, because the implications are broad and they're global. So it definitely goes into our risk assessments and our risk models, and helps us think deeper around, you know, a lot of different scenarios, how things could play out positively or negatively.
There's a clear strive for lessening the exposure towards China, both when it comes to raw materials and certain components that are being used by the big American, but not American companies. It's already clear in the data. The big winners are Mexico and some other smaller Asian economies. Is it one of the places you're contemplating? You know, essentially try to get the economies and particular companies that will benefit from the lessening of the exposure towards China.
Yeah, and I think so. The right way to think about it, one way to think about it is, you know, COVID exposed weaknesses in the global supply chain, and what it has probably ignited is a decade-long reshoring or nearshoring of that supply chain. Critical aspects of the supply chain for the U.S. will be relocated out of China, out of Asia, into Mexico, as you said, nearshoring, or back into the U.S. We think there's a lot of investment being made. You know, this is not something that happens overnight. It's done really over a multi-year time period, but we have a lot of investments in the areas of industrials, robotics, some of these companies, because a lot of it, costs are going to be higher, right? It's naturally inflationary to bring these, you know, manufacturing closer to the domestic end markets. You save some on transportation and logistics, but ultimately it is more expensive. So a lot of those benefits are going to be met through technology and innovation and change, how they actually build and construct these supply chains. And it's just starting. It's going to continue. You know, it's not super clear how it's going to work out, but I think you'll see that to be a continued theme of nearshoring or reshoring.
So higher inflation, higher rates. There is an argument for sticking more with the fixed income side of the market, or more generally with predictable, let's say, investment tools. If we narrow it down to fixed income versus stocks question, why stocks? Or more generally, how to actually play this duet?
Yeah, so I think, you know, there is a alternative for investors globally now as rates have come up, and there is a true competitor for equities, right? In the sense of you can get a relatively risk-free return at a mid-single-digit type of return. You know, our view is that over time equities will outperform bonds, that the absolute level of return will be higher, especially in areas where we see growth and growth equities, because you're getting, you know, earnings or cash flow growth of 8, 10, 12, 15 type %. And ultimately that is going to translate into higher sort of returns for your investments. And so we think that while bonds have a nice component and are actually investable again for many people, that equities will still be the place where people look to for total return. And any portfolio should have a balance of risk. And while you can't, you know, you don't want to be entirely tied to the fixed income market, I think you want to have exposure to some of these big secular themes. I mean, you can't get AI exposure through government bonds. You can't get healthcare exposure through government bonds. You can't get, you know, financial or fintech exposure through government bonds. And so we want to, I think if you want to have a future-looking portfolio, some portion of that should be in equities.
Okay, last question. crystal ball question, the usual one at the end. What do you expect is going to happen next year on the American stock market, and where's the S&P 500, let's use S&P 500 as a benchmark, going to be more or less at the end of next year, of 2024?
Well, I mean, I think it's always tough to pin a number, right, and throw the dart. But I think if we look at the big picture, right, I think rates are going to be stable. Inflation will be directionally getting better. The consumer is strong, and corporate earnings should actually grow nicely next year. That is a positive backdrop for the U.S. stock market. If I had to guess, I would say we see sort of, you know, high single-digit, low double-digit type of returns, especially if we see earnings growth in the high single-digit type 10% type level that is projected currently. You know, it's a presidential election year in the U.S. Historically, those have been pretty good years, you know, as things go for investment. You know, if we see any weakness in the economy, I think the Fed will look to cut rates to stimulate, providing some cushion there. And so generally, those are all, I think, net positive aspects of our outlook. So we have a positive outlook. We think the market will be positive next year. But there's a lot of, as we've talked about today, there's a lot of cross currents in the world economy and the U.S. market. But we think there's more positives than negatives ultimately.
To bylo lednové vítězné portfolio s portfolio manažerem Franklin Equity Group Grantem Bowersem. Na další porci investičních tipů a triků se můžete těšit už v únoru. Našeho tradičního semináře se přitom máte možnost opět zúčastnit i vy. Vše potřebné najdete na stránkách vítěznéportfolio.cz. Do té doby vše dobré, a to nejen na trhu, vám přeje partner Saving Capital, globální stratég Roman Chupatý.